como es el caso de Yolanda. Mientras tanto, nosotros tenemos que pasar al análisis internacional y lo hacemos como siempre con Pelosky, fundador en TPW Advisory. Jay, as always, thank you so much for having us a few minutes. Good afternoon from Spain.
Good afternoon, Martha. Always great to be with you.
Jay, today we are looking at the Conference Board leading economic index for the US. We've seen how declined sharply again in December. And it is indicating how conditions for labor markets, manufacturing are worst, housing construction, financial markets. This indicator has a 100% hit rate on anticipating recessions. Stock markets, in the meantime, they are talking about a soft landing. What do you expect, a recession in the US or a soft landing?
Martha, we have been in the soft landing camp for probably 6 or 8 months. I've been talking quite a bit about how we're in a high nominal growth environment globally, not just in the United States, but globally. And I think in the United States, things are moving very quickly. For example, housing, which folks are very worried about, looks like the cycle may already be bottoming in terms of existing residential housing, in part because there's so little inventory. But the main reason why we are in the soft landing camp is because there are no structural imbalances in the US economy. The consumer is fine, right? Record low unemployment, expenses, financial expenses like mortgages, credit cards, etc. Very low percentage of income. The corporate side is fine. Companies have tons of money on their balance sheet. They're able to raise new financing. The bond markets, in terms of new issues, has been on fire so far this year. And the banking sector has no major imbalances. And the big banks, which have already reported, are making, boatloads of money. So we don't see anything out there that is likely to cause a recession in the United States, particularly if inflation continues to soften, which will make it easier for the Fed to pause after it raises 25 basis points in early February.
And Jay, the countdown to next Fed meeting has begun. What decision do you expect Jerome Powell to announce?
Well, as we just touched on, Martha, we expect 25 basis points rate hike. So the Fed is clearly downshifting again, went from 75 to 50, now to 25. And we think the next move after that is going to be a pause. Because when you annualize the last 6 months inflation, the inflation numbers are roughly 2%. And the other important thing to think about is that the year-over-year comparisons for the first half of 2023 are very favorable. Inflation averaged about 0.8% month over month in the first half of last year. The last 6 months, so the second half of 2022, inflation was only averaging 0.1%. So if that 0.1% continues, then inflation will be running at about a 2% level year over year by May and June of this year. So we think after February, the Fed is going to pause and keep on hold, we think, for most, if not all, of this year. Since we don't expect a recession, we also do not expect significant rate cuts, which is what the bond market is pricing in, and we think that's a mistake.
And this week, Microsoft, Tesla, there will be the big names publishing their results. What do you expect from the technology sector in this earnings season?
Well, I think investors have again, Martha, really reduced their expectations. So the bar has been lowered. And I expect the tech companies to come in with reasonably good earnings results. We again have been on the more positive side of the earnings outlook, in part because of that high nominal growth rate environment we talked about. The US economy is most likely, we're going to have the first look at Q4 GDP later this week. It's probably going to show the US economy growing at about a 3% annualized rate. And so when you add 3% real to 4 to 5% inflation, or even call it 2 to 3% inflation, taking that month over month number we talked about a minute ago, you're at about a 6% nominal growth rate. And that is what is allowing companies to continue to show decent earnings growth. And looking into 2023, the consensus is for earnings growth of about 4% in the US, which we think is a pretty low bar and reasonably achievable.
Jay Pelosky, thank you so much, as always, a pleasure.
Thank you, Martha.